Over the past year, inflation has come down significantly, but it's still running above the FOMC's 2% goal. In February, headline inflation was 2.5% over the past 12 months based on PCE index. A year ago, it was 5.2. Core inflation, which excludes the volatile food and energy components, stood at 2.8% in February. A year ago, it was 4.8%. So this is very welcome progress, but as you can see, the job of sustainably restoring 2% inflation is not yet done. Tight monetary policy continues to weigh on demand, particularly in interest-sensitive spending categories. Nonetheless, growth in economic activity and employment was strong in 2023, as real GDP expanded by more than 3%, and 3 million jobs were created, even as inflation fell substantially. This combination of outcomes reflects significant improvements in supply that offset to some extent the effects on demand of tighter financial conditions. The healing of global supply chains helped address pent-up demand for goods, particularly in sectors that had faced considerable shortages, such as autos. In addition, labor supply increased significantly thanks to rising participation among 25 to 54-year-olds, workers in their prime working years, as well as a strong pace of immigration. Recent readings on both job gains and inflation have come in higher than expected. The economy added in an average of 265,000 jobs per month in the 3 years through February, a faster pace than we have seen since last June. And the higher inflation data over January and February were above the low readings in the second half of last year. But these recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. Labor market rebalancing is evident in many parts of the data, including quits, job openings, surveys of employers and workers, and the continued gradual decline in wage growth. On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy.